All right, here's a part two follow-up on buying options. This is Brian Lewis with MNT Investing, and things just changed. So I went over briefly on the idea with put options. Let's say that we got some put options here. That put options have an expiration date, and you want the put option to go down as fast as possible before the expiration date. And anything that's up or sideways in here, you lose all of your money. So you're paying for insurance and you lose all of that insurance money if it does not go down. It has to go down. And if it just goes down a little, you still lose most of your money. So there's three things that can happen. Uh, you can get to the expiration point, in which case you're in a spot where you do not make money, and then you just lose all the insurance money, or you're in a spot where you do make money, and in that case, an exchange will happen. So the broker will actually buy and sell those shares that you had the options on. In that case, you should have the margin money in your account to do that exchange, or else the broker is going to have to basically loan you that money to do the exchange, and they might get annoyed with you. They'll probably do it, but you don't want to have your option expire without the money to complete the option. Um, and this is even if you're winning the option and the exchange results in you making money, you still need to have the money to do the exchange. So, but most of the time, like sometimes it will expire and you just let it run out, but you almost never will have it run to expiration and actually exercise the option. This is called exercising it. Um, what happens most of the time is the option, whatever, the stock will make some moves, and then you get to a point where you're like, okay, that's good. I want to get out of the option now. So then, so like say you bought it here. So when you're buying an option, it will say buy open put. So you're buying a new put option, and then when you want to close that put option, usually in your trading software, you can click on that option and say you want to close it, but it'll just go to the trading screen and it'll say sell close put, and it'll have the exact option that you purchased. Um, so it'll have your strike price and your date on it. So, oh yeah, that's the other thing. The strike price is really important. So when you buy the option, I said you started here, but you don't necessarily start here. Like you can buy an option that starts here. You can buy one that starts here. It doesn't necessarily start where you are. So if you buy one that starts up here, that's more expensive, but you're already in a position where you can make money off of it. Um, so in order to lose all of your money, you'd have to get up here out of the money. So these are more expensive. So you won't get you'll pay a lot more. This is an in the money option. You'll pay a lot more to get an in the money option that's above where you are. And that's safer because your stock is already behaving more like the shares and less like the insurance. So the farther away you get from this line, it starts acting like shares of stock, and the farther you get up here, it starts looking more like insurance. Um, so if you buy down here, this is what's called out of the money option. So in this case, you have to get all the way down here to pass the line to be in a position to exercise it. But usually you don't exercise options. Like you could come down to here where you're still out of the money, and then you could sell that option to somebody else at that point, and you would still make money just for being closer to the area where you could exercise the option. So option trading is tricky. You have to look at the numbers because it pretty much your money pretty much exponentially goes to zero the higher you go, and then your money exponentially goes towards looking like 100 shares as you go down. So small swings make huge differences. You'll see your whole balance go towards zero pretty quick if it moves up, and you'll see your whole balance go like 10x or something if it moves way down, um, which is kind of crazy when you start trading options. Just these huge swings in the money, and then just trying to look for a point where you can trade in and out of them if you're day trading them. And then the strategy that I'm doing right now, I got a bunch of options all around this area here. I got Dell and Tesla and Uber and Visa and BP and some other companies inside the XLK ETF that had they just had good prices on the option. So when I say a good price on the option, it means that the amount of insurance money I had to pay to get the option was less expensive than the insurance on a different share. So like for Tesla, the insurance money is pretty expensive right now, and for Visa, the insurance money is pretty cheap right now. So in either case, you get 100 shares of the stock. So if you can get a cheaper option, it makes a big difference. But also, it's cheaper because people don't think it's going to go down. Like people think Tesla is risky, so they're not willing to sell the insurance on Tesla. But people think Visa is safe, so they will sell you insurance on Visa pretty cheap, um, which at the moment is kind of foolish because it's crazy volatile and Visa is going to get pulled down right with everything else. So I think Visa is a really good move right now just because the options are so cheap. And then also for options, the timing is very important. So you want it to go down right now because the closer you get to expiration, the closer you get to your option being worthless. So you want to get down into the money as fast as possible. And then when you get to the point where you think that it's going to go back up or something like that, then you just sell the option to somebody else. So what I'm doing right now is I bought options around here and I bought them out past my second target. So I got put options, most of them are out of the money, put options out to here. Because I think it's going to come way down through here. And when it gets here, I'll sell them off. But in the event that it does some stuff I'm not expecting but still comes down, I want to have padding past my second target to still try to get into the money. So that is my general idea of options. I didn't really teach you how to buy them or actually execute the trades, but that's the general idea about how they work. And we have this picture here that looks like an alien or something, which is fun. This is not trading advice, so do not listen to anything that I say. Go look this stuff up. Look this stuff up for yourself, because you don't want to get into some trades and not understand how it works, because it could be very, very expensive. This is risky, and it is time based. So options are a more advanced strategy, and that's why the brokerages, most of them make you apply for the ability to even open options. They want to make sure you know what you're doing so you don't get in trouble. So be safe out there. This is not advice. Please click the like button for the YouTube algorithm, and happy trading. I wonder if I can think of one more minute of stuff to say because I want to get to the 10-minute mark. Let's see. I'll just talk about my gold and option combo strategy. So this is the move that I'm thinking about doing is I'm in options right now trying to get down to here, but gold during a crash, gold draws down, but then on the up moves, gold shoots way up. So my general idea right now is to do options to short on the way down and then move into gold on the way up and then options again on the way down. And then this spot, gold may not be so awesome anymore because this credit contraction is only 3 months. 1 month, 2 months, 3 months, and then this reversal I don't know if gold's good anymore. We have to see. This is an expansion, so tech might be good here, not gold. Um, but that's my general gold strategy, and this is my general model for where I think things are going to go. And this is my pink alien friend. Happy trading.